Hi, everyone. This is Jason Barrack of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. We're recording this interview on Tuesday, May 27th, 2025. West Texas Intermediate crude oil prices are at $61, a little bit above 61. Brent crude prices are a little bit above $64 a barrel when we're recording this interview. Today's special guest is a returning guest and one of our favorite guests, especially for people who are looking for dividends and energy plays. He's a former senior executive at Hess Oil with decades of experience there, worked in the mergers and acquisitions division, and he currently runs the Energy Prospectus Group, which covers the Sweet 16, which are producing oil and natural gas companies that have free cash flow and dividends, and then also a yield portfolio, which has like pipeline companies and oil service companies. Dan Steffens, thank you for joining me again.
Yeah, nice to be here.
And Dan's joining us, I think, from Texas today. First, before we start talking about maybe like the data center, Stargate AI, demand increases for natural gas, I want to get your thoughts on the oil price. Do you think that the Saudis and OPEC, would they have normally cut oil production in the past when we were in the high 50s, low 60s? And why do you think they're not cutting oil production right now?
Well, I think they're trying to suck up to Donald Trump first to try to help him lower the inflation. They would love to see lower interest rates too. They would love to see, get the economy going again. And so maybe they think lower oil price, but they're also the only company only country in the cartel that really has significant surplus supply is Saudi Arabia. And, there was so many other countries that were cheating already. So, even though, so far they're going to announce another one here early next week. They said, added another 100,000 barrels a day of production, which remember, the global oil market is like 103 million. So it's still not even 1%. But the real physical increase is only about a third of that number. The other part of it, they're raising these countries' quota, but they've already been producing above those quotas before. So it's not a real increase in supply. Maybe, in discussions with Trump, they know that a lot of oil is going to be taken off the market in Iran. I really don't see Iran willingly agree to dismantle their nuclear enrichment facilities. So who knows what's going to happen there? Maybe, if they don't bomb them, they're going to have to, shut off their exports of oil or something. But who knows what? But the oil market is still, pretty tight. And, we took 200,000 or 300,000 barrels a day of Venezuelan off the market. I saw a report that Mexico's production is falling, especially their production of heavy oil. And we need heavy oil. We have a diesel shortage in the country. Our diesel inventories are about 16% below normal, which is huge. And think about this, all these data centers they're going to build, all these factories they say they're going to move into the U.S. to build them. You don't build them, with, little toys. It takes big equipment that runs on diesel to do that. The economy runs on diesel. It doesn't run on gasoline. And so that's kind of a problem. We need to work out the trade deal with Canada to get access to their heavy oil. I mean, they're still doing it, but we need to work out all those trade deals with Canada too. So interesting times. But on the natural gas side, it really, really is a bullish outlook for natural gas right now.
Yeah, the data centers are under construction, big tech with the capital expenditures. They haven't cut back. So there's been a lot of people on Wall Street and analysts that have been predicting that big tech would cut back on capital expenditures. Well, those data centers in many cases are already paid for. So there's a huge backlog, 5 to 10 years in many cases for these data center construction companies. I have a few more questions on oil, though. So did these OPEC countries with the production quotas, does it depend, or do they normally cheat with the production quotas? Because I remember a couple years ago, they were not able to produce oil. I was interviewing Josh Young, oil hedge fund manager, and he was saying how a lot of these OPEC countries weren't even able to produce the amount of oil that their production quotas, they were drastically under. So we're in a situation now, like that you just said, that some of these OPEC countries are actually producing above the production quotas?
Well, a few of them. I mean, like Kazakhstan, Iraq was producing above their quotas for a while. And yes, there are. I think there's like 7 countries in the cartel that right now cannot produce up to their quotas. So people are mistakenly looking at the increased quotas. They're not then step back and say, no, okay, what's the real physical oil that's coming to the market? And it's not even close to how much they've raised the quotas. So that's why, when they announced that they were going to do 2 months in a row of 441,000 barrels per day, the market reacted, oil price dropped to like, 57 or something. But then people started, hey, wait a minute. That's not physical increase. That's just on paper. And it's just really to take it, to get back to where they should be. And but if they do one more, it pretty much takes care of all but Saudi Arabia. It'll be like the only country that can produce more than the quota is going to be Saudi Arabia. So they'll be by July or August in total control of the only oil surplus, increased supply on the entire world. So, what's going to happen? And I don't know what's going to really happen between Russia and Ukraine, too. I mean, it doesn't look like Vladimir Putin wants to end this war. He thinks he has the upper hand. He probably does. And so are we going to slap big sanctions on them? I mean, what's going to happen? So part of this Saudi increasing production may be, talking to Trump and his team, hey, we got to get more oil out of the market. Because, even when they raise the quotas and they say they're going to do it, if it's not like you just go out and turn a bunch of valves and you can just start filling up all these ships. And it takes those ships, 2 or 3 months to deliver that oil to the United States. We actually don't import hardly any oil from the Middle East. We get about 2/3 of our oil imports come from Canada. And but it's still, you got to move that around in big tankers and it takes a long time.
So you think that the Saudis basically have been doing Trump a favor? So a lot of people from the Trump administration can go on business TV and cable news networks and say that the gasoline prices are coming down, the oil prices are
Right.
not going up. And because of that, the inflation data, the consumer price index is going to come down. So you think that that's why the Saudis basically have not done production cuts yet?
Yeah, I think so. And maybe they want in these investments, man. Maybe they want to be able to invest in these data center projects or other stuff that's going to be built in the United States because they know that, their oil is a depleting resource. A lot of the big oil fields in Saudi Arabia are already on secondary recovery methods, big water floods. And, there's only so much down there. So they know they have to diversify their economy and it sure seemed easy for Trump to go over there and get $2 trillion worth of commitments from some of them. I thought that was amazing. But anyway, but I don't see, so far, I don't see any decline in the global economy. And the only way demand for oil goes down is if you have a pretty serious global recession. And so far, I don't see any evidence of that. And boy, everything I look at is that total demand for energy just goes up, 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 all sources, and especially electricity. I mean, electricity demand is going to be going through the roof here in the next couple of years.
Isn't global oil inventories are surprisingly they've been drawn down faster than people expected. So I think I saw in the last couple weeks that global oil inventories are being drawn down at a faster pace than a lot of the oil experts, analysts covering this expected. The other issue is, like you said earlier, with the production quota. I think a lot of Wall Street hedge funds they went record net short on the oil futures contracts. Wasn't it like a 20-year high for amount of bears that were shorting oil futures contracts only a couple weeks ago?
Yeah. Well, and oil inventories normally really, well, they need to build in April and May because demand for transportation fuels, the Memorial Day weekend is the beginning of a big spike in demand for transportation fuels and not just gasoline. I mean, I tell you, I drove back and forth to Dallas for this conference, and it was like 2/3 of the vehicles on Highway 45 between Dallas and Houston were 18-wheelers. And I mean, and then, diesel's needed for farm equipment to plant our crops and all construction equipment. They're breaking ground on some big facility out just a couple miles from where I live here. I think of the big medical center thing. And there's a lot of big equipment out there working there. So
Those big rigs are probably going out towards, I'm not sure exactly where the Stargate AI facility is in
yep,
Texas, but there's documentaries. It's under construction now. They're putting capital. Oracle,
yep.
which is one of the main investors of tech companies, the server company, they just made a $40 billion purchase order from NVIDIA for those Blackwell GPUs for Stargate.
Wow. It's all big, big numbers. That's for sure.
Yeah, I mean, the construction has started. I just saw some on the mainstream news. They had a mini documentary with Sam Altman walking around the construction site. There's a lot of people there. So they're already breaking ground. It's moving along. So this is not like where it's just a press release and they're going to spend tens of billions of dollars in the next couple of years, up to 500 billion over 10 years. I mean, they've already started serious construction there. They're getting going rapidly.
Well, I saw a article about a big one that's going to be built in somewhere in Louisiana in a real poor county. But they just got a lot of land and they're close. They have a lot of natural gas pipelines and stuff running through there so they can get the energy. And it was going to create over 5,000 high-paying construction jobs for a couple of years. And then when the facility is completed, there'll be like 500 or 600, really high-paying jobs within the facility in a county that really is desperate for jobs. So it's going to be interesting how this spreads out.
And you were talking before we started recording about a lot of these liquefied natural gas export facilities that with the tariffs of what on steel and aluminum and in the higher interest rates that unless one of these companies gets a partner, say Saudi Aramco or a larger electrical utility company to invest in the liquefied natural gas export facility, you cannot use debt. And the cost, the overhead is way higher than anticipated to build some of these facilities.
Yeah. Uh, just the demand for gas just from the LNG. First of all, we're at about 15 or 16 billion cubic feet a day of export capacity with existing facilities. And the ones that are totally approved under construction are going to be built. That's going to add another 10 BCF per day of export capacity. If all of the ones that have submitted requests for approval, if they all get approved, that adds another 10 BCF. So the increase in export capacity from where it was at the end of 2024 could theoretically go up about 20 to 24 BCF per day. There's almost no way I can see supply keeping up with that. So you're going to have to get, there'll kind of be a bidding war that could get the price of gas up to where it could, take some of those LNG, make some of the LNG exports uneconomic. But these LNG export facilities also have contractual obligations, from the people that paid to build them and that want that gas. So there's the potential for a bidding war between the utilities that bring gas to your home or to your business or whatever, and the LNG export facilities. And that's why we saw this happen in August of 2022 when the price of gas in the US went up to $9. But I think we're going to be firmly over $5 here with by the end of this year. And then it just depends, if they keep piling on these export facilities, they keep building more data centers that need gas-fired power plants. You could see $7, $8 gas. I really think you could $7, $8 because right now, today, the gas price in Asia and Europe is over $12, and it's been way higher than that. So it would go higher than that. And actually, because they desperately need the gas supply from us, whatever the gas price goes into the U.S., it'll go up that much in Europe and Asia because they must have the physical supply. And the problem we've got the gas reserve. We have massive gas reserves. The problem we have is I don't think they could build the infrastructure fast enough. It's the Permian Basin, West Texas has massive gas reserves, massive, but it's not going to be cheap to produce. Those wells are drilled for oil, and they just pretty much give away the associated gas. But all the gas pipelines coming out of Permian Basin are full. Then you got the Appalachia, which is the home of the Marcellus Utica. A lot of those pipelines are pretty full, and you got political backlash every time somebody wants to build a pipeline anywhere up there. And so the only places that can really ramp up gas supply is the Haynesville, which is down in central and south Louisiana. And then also the Anadarko Basin, which is in central Oklahoma, has got pipeline access too. But I saw one report that said those two areas would need to increase their production by 17 BCF per day. Man, that's a massive increase from what they're producing right now. So that's going to be a lot of wells and a lot of well connections and gathering and processing facilities. We're going to have to be built to do that. But, the money talks. And on these AI data centers, they've got billions and billions of dollars invested in these things. So they'll pay whatever it takes to get the natural gas fired power plants built and buy the supply, and they'll secure the supply. That's why I think the bidding war for natural gas looks very bullish for the gas producers.
And I think we will see a higher price floors in natural gas in the years to come. Now, I don't know about 7 or 8, and we could have wild swings in price, but definitely higher price floors, especially if the transition is happening, as we talked about before we started recording, where people go from regular internet search with Google and stuff like that over to only using ChatGPT or other artificial intelligence software programs that are taking over search. It requires a lot more electricity for businesses and individuals on their phones on the back end to switch over to those things with the software. So you're looking at potentially an order of magnitude increase with electricity demand as people switch from regular internet search over to the more advanced artificial intelligence for research and other purposes for businesses.
Yeah, and it's big money. But the thing is, we've really been spoiled in the US to have this $2.53 gas, natural gas, because 6 MCF of gas has the same energy content as 1 barrel of oil. So, decades ago, when I first got into the industry, I actually got into the energy industry in like 77, 78, when I went full time into it. It's like 48 years ago. But the gas price always was around 1/6 or 1/8 of the oil price. I think the potential limit now, but because it'll be kind of based on the gold price, the I think we could get up to 1/10 of what the oil price. So if you look at, we got a $60, that's $6. That would mean the real price, or a realistic price for gas would be around $6. And then if you get back to 70 or 80, which I think is the right price for oil, then that's where you're going to get. And that would still be, if you had $6 gas, let's say in the US, but you could liquefy it and transport it to Europe or Asia and get $12, $13, $14, you still got a really big profit margin. So that would still work. And that's where I think we'll end up when we go from 15 BCF a day of export capacity to 30 BCF of export capacity. And that's pretty much already mapped in for now. Then I think that's what we're going to get. I think $5, $6 gas is almost sure to be on the horizon for us, which makes, a lot of these gas producers extremely profitable.
Well, I see a much clearer picture for growth for natural gas demand, for liquefied natural gas exports, data centers than I do for oil. Although I think oil is getting close to the higher cost marginal producers price, and there's just not a lot of incentive to drill new wells at this point. But the rumors are actually flying. They're very, very wild now. I've heard some just absolutely wild rumors, and reporters are on Reuters and oilprice.com that cover the oil market. They're actually saying that multiple sources that these things are true. Rumors that Saudi Aramco may invest into that Haynesville shale area for the liquefied natural gas export facility with Woodside. They may buy a large chunk of the project because they see the growth potential there. So they may invest there. But I mean, the Saudis, for the oil price, Dan, didn't they cut the dividend? They cut a substantial amount of the dividend cut. And now I just saw an article on oilprice.com today that it sounds like they're going to start floating some debt. So they're trying to buy some time here. These are not signs of that the oil market's going to go a lot lower. These are normally signs that we're getting close to a bottom.
We're getting near the bottom. And every significant pullback in the oil price that's been created by a political reason, as opposed to like the pandemic, where there was a real physical drop in demand, or you have a major recession that demand growth stops or goes negative. That's real. But we don't have that now. This is just all fear of the trade war, which is really fear of a recession. And so far, there's no evidence of that lower demand. Our crude oil inventories, our gasoline inventories, and especially our distillates, which is right now primarily diesel, those are extremely low. We're 16% below normal, where we should be on diesel inventories. We're 6 or 7% below normal on crude oil inventories, and demand for the refined products is going up, not down. So we need more crude oil, which is the feedstock to make gasoline and diesel. So I think it's just going to take, maybe when we finally, get a bunch of these trade agreements done, and everybody realizes the world's not going to go into, the next depression or something, I think the oil price bounces back to what I believe is the right price, which is in the $75 to $85 range. Uh, I'm looking at a chart right now, and if you took the inflation adjusted price of oil from 2000 to now, it is $78.37. So that's the average price. So typically, things go back to the equilibrium. They go back to the right price. And I do believe the right price is 75 to 85. I don't know when it's going to get there, but this political noise stops and we just focus on, building data centers and building factories and moving BMW here and, Volkswagen, they start building all these cars here. We're going to need a lot of energy, and a lot of it's going to come from fossil fuels. I'm just looking at like a 5-year chart of WTI, and this is why I want to think. You go back, and the pandemic was the biggest drop in oil demand ever. Okay, so in April of 2020, oil dropped to, in the real world, not the futures market, but in the real world, it dropped to $13 a barrel, very briefly. That was in April. By June, it was already back to 40. Then it flopped around in there for a few months. And then around September, October of 2020, it started climbing. And it went from 40 to 80 in January of 2022. Before Russia invaded Ukraine, it had got back to $80. And this is after the biggest demand drop ever for oil. Then when Russia invaded Ukraine, it went to $118 average for a week or two. But then when everybody realized that the sanctions against Russia were really not taking that much physical oil off the market, it got down and dropped back to 80. And then it flopped around between 75 and 80 for 3 years. And only recently, with all this noise about, recession or tariff war, well, it was really this worry about the tariff situation. And then OPEC comes out and they decide they're going to raise their quotas at the same time. So it pushed it down below 60 for a while, but then it bounced back. We're in the low 60s now, 61. But I think when the tariff wars ends, and especially when the Republicans pass the tax bill, the big, beautiful bill or whatever it is, and that makes people feel good about about our economy, and by that, the global economy, I think oil's got to get back to the right price. And so my forecasts are based on that oil's going to drift back up to 70 by the end of the year and then average 75 in next year. Now, some don't agree with me. I get analyst reports from 12, 14 different firms, and I can tell that some are using much lower prices in their forecast. I'm seeing, like companies where their low price target is 40 and their high is 90 or 20 and 60.
What a fluctuation, yeah.
Yeah, huge gap. And the only reason when you look at the analyst reports and their forecasts, it's just because of the price deck they're using. But I also think we get back to natural gas. I don't think anybody really understands how high the gas price could go. I think it could really be exciting. It was just over $9 in 2022 for a brief. We had a little bidding war on it. So it can get there, and I think that's a safe place to be right now because I don't see any downside for the gas. But oil will get back to where it needs because it has to, because you're getting these upstream companies are laying down rigs. We're dropping rigs.
Also, to add to your points there, I think we're seeing other signs of bottom, whether it's companies that are letting workers go, companies that are cutting back. The major issue there is the capital expenditure cuts, Dan. Like a lot of these Permian Basin companies with their Q1 earnings, didn't they announce like over $100 million capital expenditure cuts? It was pretty much across the board for Capex cuts.
Yeah. Because they've got all different budgets based on where the oil price is. All the small companies. I did this at Hess. I worked in budgeting every year with Hess. And you say, okay, we're going to base our budget on 70-hour oil. Oh, it bounces back to 60. And then you got all these projects you were going to do that you just cut them from the budget. That's what you do. It's going to go down. There's no way. I think.
You mean Capex is going to go down, or is that what you're
I think capital projects are going to go down, and I think U.S. production is going to go down about 500,000 barrels a day between now and the end of the year, unless oil bounces back over 70 pretty soon. I mean, within a couple of months. Because one thing is, like you said, if you start laying down equipment, laying down rigs, laying off people, they go get other jobs. It's not like you can't just, turn on, flip a switch, and suddenly you get all these rigs out there. And there's a lot of, you got to line up the tubulars, got to line up the chemicals, got to get the people and equipment. I mean, it's a big supply chain issue to ramp up a drilling program. If you already got it going and, then you just keep it going. But if you stop it completely and then to ramp up, that's a big deal and it takes time. So that's why you get these big swings in oil price because the pendulum swings from one to the other. But low prices lead to less supply, which end up leading to higher prices in the future. It's just a cycle we've seen repeated, 20 times in my career.
What are your thoughts on the comments that the CEO of Diamondback Energy made about how
Yeah.
basically Permian Basin oil production is plateauing now with all the easy tier one oil production is basically all gone, and that maybe they could keep oil production in a plateau, but basically growing it at anywhere near the levels of the past is almost impossible?
Yeah. If you stopped all drilling in the United States, our oil production would drop 500,000 or 600,000 barrels per day a month. A month. I looked the other day at the end of 2023, we had over 915,000 oil and gas wells in the United States. Now, several hundred thousand of those are high decline rate horizontal wells in the shale plays, and they're declining much faster than conventionals. A typical horizontal development well in the shale plays, once they frack it and hook it up to the pipeline, it'll produce half of its total production in the first 12 to 18 months. And that's good from an economic standpoint. When you have a good oil price, $70, $80, those wells pay out in a year or a year and a half. And then the rest of the production is pure profit. And they can just keep drilling more and more of them. Now, there's still quite a few tier one, but the problem is when you got 200,000 wells that you have to replace their production on decline, we're not running enough rigs and enough completion crews to complete enough new wells to set that. It's not that not that the drilling locations are gone, but we just don't have enough people and equipment to drill that fast. And
Or
so,
the economic incentive, right?
yeah,
When oil was at 58, there's no
right.
incentive to grow production.
Yeah, but it's the drill baby drill is just absolutely not going to happen. I mean, it's so much different than Trump's first term. And remember, they were going from conventional oil fields that were around 4 or 5 million barrels a day that were just pretty much flatlined on terminal slow decline, and they start completing these horizontal wells that come on at 1,200, 1,500 barrels a day. Well, of course, and from a percentage standpoint, it ramped up really quick. I mean, over half of our production today, more than half, I mean, two-thirds of our production now comes from these tight formations. They're not all shale, but they're all tight with horizontal wells, big frac jobs. The wells come on real strong. They produce 1 million barrels in their life. And, there's still a lot of locations. But eventually, you are going to run out of tier one locations. And then you need much higher oil prices to make the tier two locations economic. But there's still a lot of oil in the ground, but it's going to take secondary, tertiary recovery projects and new technology and all this other stuff. And we develop it, we'll do it, but it's not going to be done at $60 oil. Eventually we'll see $100 oil will just be normal.
Now, ExxonMobil just completed the acquisition for Pioneer Natural Resources, which was, I think, the largest driller in the Permian Basin. Are they not focusing on growing production right now? Are they actually going to be cutting production and focusing on efficiency? And with the acquisitions, and we saw a lot of acquisitions, whether it was ConocoPhillips with Marathon and some of the others, and Chevron, I think, with Hess. I don't know if that fully went through. I haven't checked recently. Um, are they actually these big acquisitions? Does that mean then that they're not focusing on growing production? They're actually going to be
Well,
cutting
they're
production?
still a little bit, but even Diamondback, I mean, they're going to be increasing production. They're still running like 16 rigs. I was just looking at the other day. Um, Let me look at something here, but ding, 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 ding. Yeah, great. Now let me look at one of the bigger ones here. Yeah. Oh, I don't have access to that. I've got that flash drive offline. Okay, I can't get it, but they're going to be increasing production. Now, what's hurting is, a lot of our oil wells are drilled and produced by private companies. And like on May 21st, I went to Dallas and I was the opening speaker at this energy conference up there. And man, it was packed. The room was packed. I was expecting it to be kind of gloom and doom, but there's still a lot of money looking at private deals. But they don't have access to the tier one locations. Those are pretty much controlled by the bigger companies, and it's Chevron, Exxon, you got Oxy out there, you got Diamondback, EOG. Those are like the five big producers in the Permian, and they're gonna have single digit production growth, but they're not going drill baby drill. And I know Diamondback's dropping 3 or 4 rigs, they said. So instead of having maybe a 15% production growth this year, I'll have 10. But there's a bunch of companies that are just on terminal decline. They've run out of drilling locations, and there's no really good acreage available for sale. So the only way to get more acreage is to acquire do a merger or something with another company.
So you expect then production to not grow very much or stay flat as long as oil prices stay in this trading range at the bottom end of the trading range in the high 50s or low to mid 60s then?
Yeah, and the Permian Basin is the only basin that does have upside. There's just maybe a little bit up in central Oklahoma. They're reporting some good wells, but the Bakken's pretty much on terminal decline. Eagle Ford, there's not enough completions going on there to increase production. DJ Basin's probably flat. So if a lot of people are saying the Permian has peaked or is very near to peaking, and if it's peaked, there's no way the U.S. can increase production. Now, there's also getting more interest again in the Gulf of Mexico because they know with Trump in office,
well, Gulf of America,
the opening of federal lands is, and that's opening up the Gulf of Mexico. So I'm getting a lot of questions about, which of the, offshore Transocean and all these guys, which one should we invest in? I don't really follow them that much. I'm more looking at I pretty much am looking for smaller companies for some real gems is what I'm looking at.
So what you're saying then basically is that the oil production growth and the drilling is a function of price, that if the oil price West Texas Intermediate, let's say it got back to $90 a barrel or higher, we'd start to see the rig count start to increase again. It would reverse the trend that it's on now, and we'd start to see some oil production growth. But right now there's no incentive, given where the oil price is, to do any of that.
Yeah, that's right.
I think the average listener who's listening to this podcast and doesn't know a lot about the oil market, and we get a lot of foreigners listening saying, all you talk about is the U.S. oil centric. Well, Dan, like 85%, the average person doesn't know this, 85% of all the oil production growth since 2009 is all from the Permian Basin.
Yeah. Before that was the Gulf of Mexico. For about 5 years, it was responsible for 50% of oil production growth. And then it shifted when the shale plays started getting developed. The Permian Basin became responsible for almost all non-OPEC production growth, or even the world's production growth was coming from the Permian Basin. It's the most important oil basin in the world right now.
So that means even if, like, let's say Chevron or, Chevron is fighting with Exxon over Guyana and Deepwater and West Africa or East Africa, some of the other places, even if there's oil production growth there, it's not offsetting the depletion in some of these older fields. I think that's what the average listener doesn't understand.
Mm-hmm. That's right.
Yeah, so the huge production growth the last 15 years, give or take 15 plus years, it's almost all been from the Permian Basin. That's been responsible for keeping the oil price relatively low.
Yeah, it's because where you add up everything else, and there's some going up a little bit, but a lot of them on decline, like Bakken, and so they offset each other. So the only place when you get everything out of the way, it's just the Permian's the only one with growth.
Now, I want to ask you about low-cost producers' valuations right now. Are we going to start to see mergers and acquisitions? Because I mentioned wild rumors a few minutes ago, and then I didn't follow up on all of them. So there's wild rumors of the Saudis investing in liquefied natural gas export facilities in Louisiana and Woodside's project that they bought from Tellurian. There's also rumors of Royal Dutch Shell, ExxonMobil, and Chevron looking at buying BP. We've had acquisitions for the last couple of years. Do you think we're going to see more at these current valuations?
Yeah, I think there could be. The guys that have access to capital, the problem is these kind of little and mid-sized companies, they have to live within cash flow because they don't have much access to capital and then if they start going in debt to grow, that just kills their stock price. So I tell you, there's a lot of good bargains out there. I've got several companies on my watch list that are trading for 2 or 3 times cash flow. Heck, when I was at Hess, if we could buy a company for 5 or 6 times cash flow, we were happy to get it. But everybody's got such a short term, outlook now, and and Wall Street always assumes you overpay for stuff when you get it. But you look at my Sweet 16, and these are really, really high quality companies in my top picks of the Sweet 16, and they're trading for below four as a group, they're trading below 4 times cash flow. And there's several of them on here trading for less than 2 times cash flow. And then even the bigger ones like Fang, Diamondback, 4.5 times cash flow, EOG, 5.5 times cash flow. These are fabulous, fabulous companies with a ton of running room. And they're on sale. They're on sale. And when the mood flips and oil starts drifting higher, I think you're going to see a lot of money moving into the sector. And all these companies, in my Sweet 16, the one that produces the lowest amount of natural gas and NGLs, it's 40% of their production. I mean, half of the companies on this list, if you go on a BOE basis, barrel of oil equivalent basis, over 50% of their production is gas and NGLs. So the oil price may be going down, but the gas price is up like 30 or 40% year over year. So my first quarter results, all this gloom and doom. So they put out first quarter results. First quarter results for almost every one of these companies was better than fourth quarter results. Now they're going to go down, take a step down in the second quarter, but they're still going to be profitable. They're all looking profitable for the whole year.
Are these investors that you met in Dallas, the private equity and the other investors that want to put capital to work, are they targeting natural gas producers because they're seeing what the natural gas demand growth there for liquefied natural gas and data centers for artificial intelligence? So they're specifically looking at companies that are lower cost natural gas producers that could potentially be near a data center that's being built?
Yeah, well, this conference, and I've spoken at this was the 8th year in a row that I spoke at it. It is for uh, private equity type deals. It's private drilling programs. There was some projects for. I didn't stay for the whole thing, but I saw somebody on the list that were talking about power generation projects and stuff like that. But there was a lot more interest in natural gas this year. Now the attendants at this thing are some investors that manage a lot of money, and then also private equity are broker dealers and stuff that sell these drawing partnerships and stuff. But they had a little chart that they put up before I was speaking that said last year the presenters at the conference took in 1.8 billion, which was double what it was the year before that, and they were presenting some big projects for this year. So there's a lot of private equity looking at energy deals. I'll tell you that.
Yeah, because these data centers are under construction. I think in the headlines, our listeners out there will see that Chevron has been making plans and announcements. I think they partnered with General Electric with a natural gas turbine company for efficient. So Chevron's going to be building the pipeline, the natural gas power generators around the data center, and then General Electric's going to be providing the turbines. So these are partnerships. This is a lot of heavy construction involved. You have to build the infrastructure out, as Dan said earlier. You have to build the pipelines. You have to build the natural gas power generation and the turbines around the data centers. Unless you can get a nuclear power plant built, there is no other viable option to power these to power these data centers. There's no viable option other than natural gas besides nuclear power, and the U.S. is very slow at developing new nuclear power plants.
Yeah, and several companies in West Texas, the upstream companies, they're building their own power generation to run their pumps in the field because gas price is so cheap. There's no pipeline access, so they just had all this stranded gas. So they're building their own power generation. I got one little company I follow is called Solaris Energy Infrastructure, symbol SEI, and it pays a little dividend too, nice dividend. I've been following it for like 6 or 7 years. I actually met the management team up at a conference in Dallas at SMU University. I was very impressed by them, and they also handle frac sand and stuff at the well site. But they recently merged with a private company that does modular electricity, to use gas in with smaller turbines. But they can, build something for up to a gigawatt. But it's SEI. Go to their website and you can see what they do. But when they announced the deal, the stock price like tripled. It's pulled back now. I think it's at a very good price. Somebody like Cities or somebody put out a price target on it about 50% higher than where it's trading right now. So it's drawing more interest again.
Now, I want to ask you about the pipeline companies. We cover this every single time. We've talked in past interviews. It sounds like the pipeline companies were building massive pipelines, like the Matterhorn pipeline, whether that was like One Oak or Plains All America, or even I think what Enbridge, the Canadian company, was involved in this too. They're trying to build pipelines, from the Permian Basin, either down to liquefied natural gas export facilities in Texas or Louisiana, or they're moving it to data centers. Do you think that we're still underinvested in pipelines right now?
Yeah, we definitely are. The one that looks really good to me is Plains All American. PAA is a master limited partnership, but you can buy the general partner that pays the same dividend. It trades as PAGP, so Plains All American General Partner, and it's just a regular dividend. It's a C corp, and really the only thing it owns is units in PAA. But the stock is trading below book value as of today, and I don't get that at all. And they pay a really nice dividend, and it looks like to me, from my forecast, they're going to be able to raise their dividend, and it's I think got about an 8 or 9% yield. Let me see here real quick. Yeah, PAGP as of Friday's close had an 8.5% dividend yield. And of the four midstream companies that I have in our high yield income portfolio, it's got the highest yield. The Wall Street gang also kind of looks at these pipeline companies as utilities. They don't have really high dividend yields, but they have very secure. As long as their pipes are full, it doesn't matter what oil or gas prices, they're toll takers. So they got strong cash flow. So they have very good, distributable cash flow generation. One company I think we mentioned before we start that's not, this is an upstream company up in Canada. It's Peyto Exploration and Development. I just, modeled it a couple months ago, and it's got about a 7% yield. Looks really good. But I like the minerals companies. I think we've spoken about that before. Some of them, all the four that I have in here, range from Viper has like a 6.3 dividend yield, and it goes all the way up to Blackstone Minerals, which is heavily weighted to natural gas, has 11% dividend yield, and they will probably be increasing their dividend if gas prices keep going up.
Do you think any of these natural gas producers have a huge advantage with costs, or they have the pipelines that are being built or already there in place to the data centers under construction?
Well, the one that really has it together is EQT Corp. It's the second largest producer of natural gas in the United States, about 6 billion cubic feet per day. They recently acquired a midstream company, so they're like a fully integrated. They have access to good markets. Their realized gas price post-acquisition, because of this midstream thing, their realized gas price went up a lot more than I thought it was going to go. And if gas goes to 5, they could be literally generating a 1.5 to 2 billion of free cash flow per quarter. I mean, it's got tremendous upside.
Is
Of
that
the
way
gas.
more than projected?
Yeah, nobody's really putting $5 into their forecast. I'm just saying if gas goes to 5, it's got it. But even if gas stays at 350 or something, it's going to be very free cash flow positive. The other gas, like Range Resources, looks good. It's probably the safest one of the bunch. They control about 1 million acres up there in Appalachia. That's Marcellus Utica, and a lot of their acreage is held by production, so they don't have to go drill. They'll pay. They've drilled pads where they've only drilled 1 or 2 wells from the pad, but they may have 6 slots. They could drill, 4 or 6 more wells from that pad, but that holds all their leases, and they got some really good acreage. Antero Resources really, really looks good. The only thing I don't like about Antero yet, they don't pay a dividend, but boy, they've got the upside for production if they want to. And then Coterra looks really good too. CTRA.
Now, do you think the liquefied natural gas export facilities, do you think that there's going to be delays for some, or some of the projects are going to potentially be canceled? Because I know Trump is saying, and his energy secretary, they're going to approve the permits for the liquefied natural gas, but now they put tariffs, what, on steel, aluminum, that are needed for construction, and then you have higher interest rates, so you can't really, if you're a smaller or medium sized company, you can't use many billions of dollars at debt at a high interest rates to build a facility.
Yeah, the thing is, I know, he wants to bring the steel industry back to the United States. That's a good goal. But in the near term, that's not going to happen overnight. You don't build a steel mill like overnight. So we're going to need a lot of steel and a lot of aluminum. The two main things that go into an LNG export facility are steel and aluminum. And if these tariffs are enforced, these 20, 30, 40% tariffs on steel imports, you've increased the you've increased the cost of these LNG export facilities by 30 or 40%, and makes them economics look not very good. And so a lot of these that aren't permitted yet, they may lose their funding because they're not going to be able to justify going forward. But like I said, just the ones that are already definitely going forward, they're definitely going forward, and some of them are darn near complete. Exxon's got there's one called Golden Pass. That's the next big one that's going to be coming online, and it's an Exxon facility, and it was supposed to be online by the end of last year, but it's going to be in the second half of this year. So within a few months, it's going to be coming online. And another big thing that's going to help our friends to the north is LNG Canada is set to come online with a 1.8 BCF per day capacity LNG export facility on the west coast of British Columbia. Then they can export their gas directly to the Asian market. But that is going to debottleneck Canada, and will should have a significant impact on the gas price up in Canada. And there is a lot of gas up in Canada. I mean, we need to resolve this trade war with Canada pretty quick. We need their heavy oil. We're going to need a lot of their gas in the near future, and we need their steel and aluminum. We get most of they are the biggest exporter of steel and I think aluminum to the United States is Canada.
Are you covering Venture Global? That's the liquefied natural gas IPO that was earlier this year. So are you covering that one? Because that's the other
No,
big growth picture.
yeah, no, I'm not. But I do know their facility is at Plaquemines, Louisiana, and it's ramping up quick. And so it's going to be a very, very profitable facility.
Do you
So that's a
know,
good company, no doubt about it.
Dan, do you know if some of these liquefied natural gas facilities that were under construction, are they getting like exemptions on the tariffs? Because what you outlined, basically, these tariffs could potentially really hurt the economics of a facility that's under construction already. Do you know if any of them are getting exemptions on the tariffs?
Well, they're exporting, so they're not going to be, if they're paying tariffs, it's to the companies they're exporting to.
Oh, no, no. I mean like tariffs for like the sorry, like for the steel and the aluminum for the facilities under construction, be like
Oh,
Trump, because Trump is giving out exemptions. I mean, certain entities,
yeah.
whether it's I think big tech companies, were getting some exemptions on things.
Yeah, I think when his team can really focus on some of this stuff, they're trying to solve a lot of problems really fast. So they got a lot on their plate, but they have to, lower the barriers to steel and aluminum. I think it's just got to happen, and it will.
And in the
It's
last
going to
week,
kill the economy just for the hell of it.
yeah, I mean, like if he's giving people exemptions, it's picking and choosing winners and losers. So I would
Yeah.
imagine that I just checked news stories for Venture Global. Looks like they just got permits for an expansion project for CP2, and when that comes online, they're going to be the largest liquefied natural gas exporter in the United States.
Yeah. And I think when a little reality sets in, because they first put a 10% tariff on oil and gas from into Canada, and then it was like 6 weeks later they dropped it. So they knew we needed it. I mean, his energy secretary said, Donald, we have to have oil and gas from Canada. The entire Midwest refinery network relies on Canadian oil. So
It seems that this is the first time in a maybe ever where you have big tech, nuclear power, natural gas, and the energy industry, all along with heavy manufacturing, willing to cooperate with each other. Because if our listeners go and look at there's a mini documentary out on Stargate AI construction with Sam Altman. One of the major news networks filmed him going through the construction right now. I mean, there's a bunch of different companies all working there. It's pretty amazing.
yeah, I mean, all this talk about like global recession or something, or these tariffs wars are going to put us in. I tell you, I've never seen, I've been doing this for 50 years and I've never seen the demand increase in energy. I mean, just all forms of energy, but let's say electricity. The demand in electricity, we've never had a period like this. And so that means a tremendous amount of infrastructure and the grid has to be upgraded and all this stuff. So this is a massive, deployment of capital. Well, that's not something that tells me we're going to have a recession. That tells me we're going to have a booming period. I mean, he needs to get the Fed to lower interest rates a little bit. And next thing you know, we'll just take off.
Well, I don't know about an official government recession or not, but I could tell you the energy industry is working with big tech for these projects, and the capital is being committed, Dan. So unless we see announcements from Nvidia or Microsoft or Apple where they're cutting tens of billions of dollars, and we have not seen these things yet, they're projecting $300 billion of capital expenditure. That's just the five or six largest technology companies. That's not counting the Stargate
Yeah.
AI project. That's not counting any investments European Union makes in data centers, that any of the Chinese technology companies make in data centers. So and those estimates are, we don't have accurate information for a lot of those estimates for foreign countries. So at least $300 billion is going to be invested in artificial intelligence, software, and data centers unless they announce cutbacks. And
Yeah.
that's going to benefit the energy industry, especially natural gas, I think, and nuclear power.
Yeah, I would just look at my slides right now just to tell your listeners why I think this is a great time to start doing your research, finding some of these high quality energy producing companies and start loading your portfolio with them because of this stat. There is less capital invested in the energy sector right now than there was during the height of COVID. It's that low. It's that you know, under what do you call underperforming? I mean, performing. I mean, the companies are doing well. They're profitable. It's just that, you get this gloom and doom stuff get started because oil drops $10. Everybody freaks out. But remember, the companies that are alive today, they survived the pandemic. And it was way worse than it is now. So they're going to survive a quarter or two of, oil being in the low 60s. So what? But because gas prices and NGL prices are going through the roof and they produce both. So they're in good shape. And I think, the Wall Street gang is going to figure this out and they're going to start talking this up. And you're going to get a lot of money rotate into when the tariff war is over and everybody says, hey, it's okay to invest in energy now. I think a lot of money is going to be coming into the sector in third and fourth quarter. I'm really optimistic about where these stocks are going to go in the second half of this year.
Yeah, I think the key is the capital expenditure, whether or not there's capital expenditure increases or cuts, because the projected budgets are massive. I mean, they're spending many, many billions of dollars. They've already invested, I think, over the last like 2 years, hundreds of billions of dollars are projected this year alone. Around Meta increased capital expenditure budget to around 72 billion for 2025. So they were projected, I think, 65 billion was the range, and they actually announced an increase because they're doing open source. So they're buying up all these data center projects and leases. They're investing. They just released a new augmented reality glasses that has artificial intelligence software built into it. So I mean, all I see are new products. It seems like every couple weeks or month, there's new artificial intelligence software products, and the computing power on the back end is going to be required. So the average person, Dan, pulls up ChatGPT on their phone and they think there's no difference whatsoever between a Google search and ChatGPT. On the back end, it is very, very different for electricity usage at the data centers for you to run ChatGPT on your phone.
Yeah. Well, interesting times.
Well, it sounds like the investments are going to have to be made for the pipeline company. So if you're a pipeline company or you're Chevron, because Chevron's going to be doing some of this too, that's where they want to make the investments and set up the infrastructure, that there's going to be a very long-term stable profits at these things to set up the pipelines to the LNG export facilities or to the data centers.
That's true. Yep. All takes steel, though. We got to have steel. Steel and
I mean, the U.S. used to be the best producer in the world of steel with U.S. Steel. That was obviously a long time ago, but it's still
yeah.
here, barely. It almost got bought up by a Japanese company, and then I'm not sure how the regulatory. I'm not sure it was. They were going back and forth. I can't remember all
Yeah.
the details.
Yeah, well, we got an interesting president, an interesting team. If he can pull all this off, it's going to go down in history as something pretty fabulous, I think. So we'll
Well,
see.
he is getting investments, right? So he's
Oh
getting the
yeah,
investments. Now I don't know if there's going to be a lot of human jobs because things. I don't know if you've seen the videos here. There's a lot of humanoid robots that are those things are
yeah.
progressing, but that's going to use even more energy.
I know that's the thing. It all requires energy. You can't grow the economy without energy. So it's and fossil fuels are not going away. There's no way. There's no way wind and solar can keep up with this kind of stuff because they're not reliable enough. I mean, the AI data centers need 24/7 electricity, and it can't go down. I mean, you can imagine if you got all these companies relying on a data center and then suddenly it has to go offline. Heck no, they have to have steady electricity. So they'll pay whatever it takes to get it.
Well, there's also Jevons paradox. I don't know if you've researched this, so I get questions asked this a lot, so I'll just give my thoughts real quick. But people can look it up with artificial intelligence research software for more analysis. But basically, Jevons paradox applies to artificial intelligence software and data centers. And the better products, the better the software productivity efficiency increases in the software, the cheaper it becomes. So
Mhm.
if you have a version of that Google video artificial intelligence software called VEO3, and the price goes from $250 a month down to $50 a month or less, and you're getting what 4K or 8K quality video for commercials and all these to make movies or anime or any of these things. If the productivity is improving and the cost is coming down, people will use it more, and then that will require even more electricity usage. So that's what the Jevons paradox is that as the software improves and the costs come down, the use cases for it in many businesses and many industries will increase, and we're going to use even more electricity than people are projecting.
Yep. We do every year, and it's going to keep going up. So,
Well, I mean, like these new software releases are coming out like every month now. So it
yeah,
seems like whether it's a Chinese company that's improving like productivity with the software, so the costs are coming down, people are going to be using it more and more. You're seeing it with the Google data. Google just announced basically a lot of their regular internet search, they're losing a lot of that business.
yeah. Oh well, all right. I got to get going, man. So, you want to end this?
Yes. Well, I want to thank you so much for your time today. Please tell my listeners more about the Energy Prospectus Group and your model portfolios.
Yeah, we are. I get my money from subscribers to our service. It's $350 a year, and you get a newsletter with our three model portfolios in it. The Sweet 16, which is kind of my large cap, mid cap, top picks. Then we have a small cap growth portfolio. Profitable small cap companies that are right now screaming takeover targets for one thing. And then our high yield income portfolio. So I'm looking for companies that have sustainable dividends of 6, 7, 8. Some of them, one of them here has 12% dividend yield, and that they're sustainable. And we follow like 38 countries or so. One of our companies, one of our members is an ex-Shell executive. He was the head economist for Shell based in the Netherlands. He's one of our members, and he supplies a ton of high quality information to me. He has a database where he's following 85 companies, and he force ranks them based on what he thinks the ones that have the best value per share. And we also distribute his stuff. So to get me, just go to energyprospectus.com. That's energyprospectus, one word.com. Or you can email me or just send an email to energyprospectus@gmail.com. Tell us that you heard about us on Jason's show. And I think so that'll go to Sabrina. She does our member services, and ask her for $100 off your first year of membership, and she'll give you a promo code for that.